Welcome back to Alberta Primetime. We are learning now where most people have plunked their RRSP money, mutual funds or GICs. Do you like your investment? What's in it for the salesperson? We'll ask our Monday Money panel tonight. Jane Alm is an investment advisor with Angus Watt Advisory and National Bank Financial. Beth Hamilton-Keene is a director and portfolio manager at Moore Investment Management. And in with us tonight as well, Shafiq Harani, director and senior executive financial advisor with Investors Group Calgary. Good evening, everybody.
Good evening.
Hello.
Good evening.
BMO Financial Group has released its summary of RRSP choices following the 2011 contribution deadline days ago. And this year, the top pick, the mutual fund, even though everybody is exacerbated by it. 59% of Canadians opted for them. Only 25% chose guaranteed income certificates. And you see the rest of the lists there, equities, bonds, and ETFs down. Not a choice for many. Jane, before we get into the specifics there, are planners perhaps likely to talk clients out of GICs? Less than half went for those.
Well, part of the problem with the GIC today is the rates of return. If you're looking at a one-year GIC, it's around 1.45. If you go out to a 5-year, you can get 2.25, in some cases maybe 2.4, but you're barely meeting inflation.
But you're not losing anything.
You're not losing anything, but you're at a point where you may as well just put your money and not do anything with it as far as gaining on inflation. Yes, there's a guaranteed component there. Most people on their RSPs are still looking at it as a longer term investment, so they're looking to try to have some growth. And we've had a pretty good market since last October. Many people, the greed side will kick in and they'll go, the market's been good, I think I'll try and put some there.
Beth, Alberta, Saskatchewan and Manitoba led the way with 42% participation in RRSPs before the deadline. Canadians kicking in just over $4,600 annually on average. But let me get to a question that, Jane, I noticed you didn't really answer for me. Commissions. What do financial planners make on mutual funds versus GICs or other things? Is it different for the advisor?
Well, it certainly can be, and just like the word mutual fund is, there's a broad range and spectrum. So you've got to really know and work with your advisor and understand how they're getting compensated and how they're getting paid. There are a few tricks. Certainly, when you look at a mutual fund, if you're looking at a high management expense ratio fund or a fund that has a deferred sales charge or a front-end load, there's generally additional commission built into that. So you definitely want to have that understanding when you're making those investments. If you're looking at GICs, there are some GICs that do pay some advisors. Of course, it's usually a lower spread or a lower commission. So most advisors, I believe, will truly recommend the right investment for their client, first and foremost. That's how most investment advisors should be operating. But definitely, on behalf of the investor, you really want to shop carefully and buy wisely.
Shafiq, just finally on that, if we're trusting our advisor and we're sticking with someone because we do feel good about them, if you look at big pharma and doctors, I mean, you can't get perks anymore for prescribing a certain medication. Shouldn't this be a little bit more structured? We're just going on good faith here.
Yeah, and you got to be a little bit warranted about that concern, because the facts remain in the past. ETFs have actually outperformed 80% of all mutual funds, yet the advisor probably gets a higher commission when he's recommending this mutual fund. So I'm actually surprised that the report didn't indicate that ETFs themselves were a growth, but I think there is a proponent on the value of advice. And I think there's a really good research report that the Investment Funds Institute of Canada put together towards the value of advice. And basically, mutual funds, like Beth was alluding to, have different types. There's fixed income and equity funds. And it's about that advice that they have to be warranting their commissions. That's the one thing that all advisors should be aware of.
Jane, when we plan for retirement, do enough Albertans consider their loved ones? Many elderly pass away and there's still lots of assets.
There's still lots of assets, and when you're doing your financial planning, the estate planning is a cornerstone of that, trying to figure out the best way, the most tax efficient way to get assets into your loved one's hands. You need a professional. You need your advisor, you need a lawyer, because you're working within tax law, and sometimes you need an accountant involved, depending on the complexity of the actual plan that you're working on.
So Beth, that sounds like step 2. Okay, we did our RSPs, the deadline's over, we still should be looking at them for 2012, but a lot of people just stop there. Can you expand on what Jane's saying?
Sure. Well, in fact, most of the time it's when you very first open that RSP that you designate your beneficiary, and often you don't reconsider who that beneficiary is with your additional contributions as they go by. So the years pass by. You may have been single when you started. You're now married. Instead of your father as your beneficiary, it should now be your spouse. Or as you age and your spouse has passed away, I've seen many cases where elderly men and women have still left their deceased spouse as the beneficiary and so forth. So definitely something that's worth reviewing. And in fact, the entire estate planning process needs to be reviewed. And if this is the time of year that reminds you to do that, it's a great time to sit down and reflect. Is there any changes that I need to make? What is my beneficiary designation? Many of the statements that are provided by your providers actually have your designated beneficiary right on the top. You have designated so-and-so as your beneficiary. Is that the right place?
But Shafiq, I guess you can make it easy or difficult for those dealing with your estate. What's your advice?
There's four things. First of all, anything you put in joint names will go to your joint survivor. If you have an RSP, a TFSA, a life insurance, revisit it and make sure there's a beneficiary election on it. Also, you gotta not just seek a financial planner's advice or an accountant's advice, you really should seek a lawyer's advice, because I've seen situations where a husband will pass away, leave everything to his wife, and with the intent of leaving things to their kids, written up by the will, but then the wife will remarry another guy and he'll have previous kids from a marriage, and then she'll pass away and leave everything to his kids.
Exactly.
And so you want to make sure that the estate plan has capital beneficiary trusts and it's really thought of all contingencies.
Not only that, but the laws change as well. And in fact, in Alberta, the Alberta Will and Estates Act is changing and is certainly proposed to be changing. And so all of that requires a constant revision. I'd say at least every 5 years to review the will and estate in its entirety.
Talk more about the tax savings you mentioned, Jane.
The tax-free savings, well, the tax savings on your estate, because there's certain assets that flow to your loved ones without any tax. Insurance policies, benefits from insurance policies. Your principal residence doesn't have a tax on it. RSPs can flow to a spouse or to a child if the child is either under 18 or if they're permanently disabled. So there's a lot of things that need to be considered when you're doing this. There's other things like farmland that have very special rules around how they can apply and how they can be transferred.
Welcome back to Alberta Primetime and the Monday Money Panel. Each week we ask what developments our panelists are watching. Beth, in Calgary, you're looking at some contraction east and farther east. What's up?
Well, certainly markets are reacting today based on the news out of China that they've set a GDP forecast of 7.5%, which is lower than it's been in the years past. So that is an indication. Of course, China is framing that they are watching and maintaining and managing their growth, and that leads towards the more accommodative policies that they've been announcing more recently. And of course, the markets are reacting to that. If China is not going to be growing at the same rate and clip that we've been expecting, what does that mean for the rest of us in terms of the demand and so forth from a global economic standpoint?
Jane,
that in addition, go ahead.
Sorry, no, finish up, Beth.
That, in addition to some new European debt woes as it regards to Spain, have tilted the markets into the negative spot.
Right. Jane, you're keeping an eye on oil.
On oil, yes, and specifically in regards to COSIA that I know you did a spot on last week.
The new Oil Sands
which
Technology
is the new
Alliance.
Oil Sands Technology Alliance, 12 companies. It's very, very important because the European Union had a vote on whether to ban our oil sands oil as being too intense for the environment. If these companies can work together to lower the greenhouse emissions, to lower all the environmental concerns, then that will relieve some of that pressure on the EU and on other countries, even the US. And most importantly, on the environmentalists around the world, to accept that this oil is not as bad as some of the other oil in the world.
Could that help raise the price?
It could. What it could do is help lower the differential between Alberta oil and the rest of the world, because right now that is weighing a little bit on it, which would help our province. If we saw oil prices spike for some reason up into $130 area and stay there for a prolonged period of time, that would hurt the economy. But unless we see that, I don't see it as a huge negative today. We're just watching Iran and Israel to see what they do with their saber rattling contest. And
Shafiq?
Yeah, I'm like Beth is saying, I'm looking at China and they're changing their depository reserve requirements and a lower forecast on GDP. They need a soft landing. Like Jane, oil is important. I'm looking very domestically over the next week. There's some big reports coming up internally. On Thursday, Mark Carney is giving his monetary report on the future of monetary policy and interest rates in Canada. So that, you know, the majority of my clients are in Canadian investments. I think that's also very important. And there's a lot of the jobs numbers come out Friday. That's a big one for Canadians.
Canadian banks are posting better than expected quarterly profits right now. They boosted the TSX last week. TD and RBC upping dividends to investors again. Beth, what is the range on big bank stocks in terms of what they cost per share? Are we looking, you know, $50 to $70? Is it too late to buy in if we missed the opportunity?
Well, it's too late for the surprise, for sure. The surprise, of course, was that earnings were better than expected, than most guidance had been given and than most analysts expected. And dividends were increased by a number of banks. So that was the surprise in the markets last week. In terms of going forward, you know, we can certainly get some assurance from the numbers that we've seen that the Canadian banks are indeed in a very strong position. It's very promising to see that all of our Canadian banks at this point are Basel III compliant, which gives them that capacity and that ability to return and increase the dividends to their investors. So those are all positive things. In terms of headwinds, though, the headwinds still remain. We are still watching what the effect of the delevering of our Canadians. As the Canadians borrow less, where will the growth in loans come from? In fact, it probably won't. We'll certainly see a flattening off or perhaps a drop in that. What about interest rate risks? Certainly margins will be threatened. And of course, the last piece is if we do have a housing bubble or a bit of a housing correction, what will that do to the Canadian financial institutions?
Jane, some people might complain about the fees they're paying. How much of the bank's profits is on the backs of consumers?
Well, there's some on the backs of consumers, obviously, because you do pay a fee. But consumers have to understand that when banks make money, they probably own those banks in their mutual funds, for sure in their pension plan, and all the other investments that they have. They may not own them directly, and they don't mind when those go higher. So yes, we have to pay a fee, but you have to pay a fee for any service. If a service is worthwhile, you do pay it. We have to be very proud of our banks on what they have accomplished in a period of time when banks around the world have undergone a lot of stress.
Shafiq, couple seconds left. Bullish or bearish on banks for you?
No, bullish for sure. I mean, I've never, the banks go long term, they've made money, they've raised their dividends every year. They're long-term investments. I mean, I know a lot of people are upset with the management fees in banks and upset with how much they're making off the consumer. Invest in them then.
Okay. Thank you all for your time tonight.